Charles Sizemore here. So I'm going to shake it up a little bit this week. Normally, I give you a dividend stock to buy. Well, today I'm going to give you a dividend stock to not buy. Investing, one of the best quotes I've ever heard, and I believe this might have been a Warren Buffett quote. If it wasn't, I'm plagiarizing. But there are no called strikes in investing. You don't get penalized for not swinging the bat. There are times when it's okay to not buy something or to just let something pass you by. You have limited capital. Not even the richest man in the world has unlimited capital. You can't buy everything. There are things you should just avoid. And it's no different when it comes to dividend investing. So as you've seen in prior shows, I like high yield, of course, but more than high yield, I like consistently growing payouts, because at the end of the day, you can have a high yield today, but if this is something you're planning to hold for the rest of your life or planning to hold throughout, perhaps multiple decades of retirement, if you're not keeping pace with inflation, you're going to get poorer every passing year, every passing day, really. So that growth is important. So you want stable companies, but you don't want stodgy companies that just simply aren't going anywhere. So with that as intro, I really do not like utility stocks. I never have. They're viewed as this sort of widows and orphans appropriate sector, people looking for income. The problem is, it's just not true. They don't pay enough these days. Perhaps 30 years ago, utilities were a great stock for those proverbial, widows and orphans who needed income. They actually paid a yield back then. These days, they just don't. The dividend yield is higher than what you would get in the broader S&P 500, but it's much lower than in a lot of the other dividend sectors I like. For example, REITs. To me, I would much rather own a real estate investment trust with a healthy property portfolio that has natural inflation hedges. If you get inflation, that raises the cost of land, it raises the cost of buildings. Like those properties become more valuable. Plus, the rents increase. REITs almost always have inflation kickers in the lease, to where if inflation rears its ugly head, the REIT is insulated from it. Utilities don't really have that, not the same way. They're regulated, and there's a limit to how aggressively most utilities can jack up rates before the regulators step in, or if not the regulators, just public shaming. Remember, it's bad publicity if you have that. Again, the widows and orphans buying these stocks are also customers of the utilities, and it doesn't look good if the evening news comes by and they're complaining about how they can't afford the light bill anymore. So it's a different competitive environment, and then you add to that also with solar panels and other green initiatives. It's just a different ball game now for the utilities. If I were to put solar panels on my roof today, I would be mostly off the grid. My house would be mostly self-sustaining. But there are times when either the batteries didn't store enough, or it's a particularly high use. The sun's if it's really hot in Texas that day, I might need supplemental power. So from the perspective of the utilities, they have to stand by, willing, ready, and able to supply me with more electricity if I need it. But most of the time I don't. So that it's expensive to maintain that availability, but then not bill for it. So it's really a tough competitive environment to be in. And I don't see it improving. So in utilities, you have, slow growth dinosaurs. They don't yield what they used to. They don't really keep pace with inflation, or if they do, just barely. And you have, what was before a pretty stable operating environment looking a little bit more unstable now with competition from renewables. So with all of that as an intro, I'm going to use as an example Duke Energy, ticker symbol DUK. This is one of the larger utilities out there. 7.9 million Americans use them. They have 7.9 million customers here. Covering 91,000 square feet. So these guys are big. They cover a broad swath of America. So digging down, it pays a 3.9% dividend. Okay, that's not bad. By the standards of the utility sector, it's fairly high yielding. It's better than what you're going to get in bonds for sure. But that dividend growth rate is 2.9% over the last 10 years. That keeps up with inflation, but not by much, right? I would much rather, right now, you can go find, just take your pick. You can throw darts at a dartboard and find a REIT yielding more than that. REITs, even conservative REITs, yielding 4 or 5%. I would much rather have that 4 to 5% yielder raising its dividend at 5% per year than a less than 4% yielder raising its dividend at less than 3% a year. That's really kind of a no-brainer. So let's dig deeper. Let's look at it via the lens of our green zone rating system. Yeah, I admit I have my biases. I told you at the beginning, I don't like utilities. I never have. They're my least favorite income sector. But is that my bias? Is that just me having a sour attitude towards the sector? Well, let's look at the numbers. On our rating system, Duke Energy rates an 18. That's 18 out of 100. So I'm not exaggerating when I say that's poor rating. Not only is that in the bottom half, it's in the bottom quarter. And the thing is, it doesn't really rate well on any submetric either. Its highest submetric rating is a 74 on volatility. Okay, great. It's a utility stock. It's supposed to be non-volatile. Again, the clientele for these are those proverbial widows and orphans. If this was a high volatility stock, that would be strange. But even a 74 for a utility isn't that great. You would expect utility stocks to be at the absolute top end of the scale here, 99. You would expect utility stocks, given their nature of slow growth beasts that don't really do much, you would expect them to be about as non-volatile as bonds, but they're not. A 74 volatility rating here means that there's still a quarter of all stocks in our universe that are less volatile while probably offering better growth. So if your best rating is a 74 on volatility, that's not so great. Looking down, they don't have a single other submetric that even rates in the top half. Value is the next best, and it's a 47. Okay, great. Value stocks are in vogue again, but we're not even in the top half there. Momentum, ironically enough, looks comparatively, not bad compared to some of these others. Momentum is at 38, but still, that's barely in the top. That's barely in the. That's not a good rating. We're really grasping at straws to make a 38 on momentum look good. Quality even rates lower. It rates at 30. Now, remember, this is considered one of the blue chips in the utility space. And even the blue chip in the space doesn't rate well based on quality. Why? Because our quality metric really likes capital light businesses. It likes businesses that have really high returns on assets, investment, very high turnover and low debt. Well, none of those conditions hold for a utility. Utilities are very capital intensive. They have a lot of debt usually. They usually finance it, and their returns are middling. I mean, at the end of the day, it's a utility. What are you really expecting? If their returns were too great, the regulators would step in and squash it down. It looks bad if remember, these are monopoly businesses, and it looks bad if you have a big profit. So but they're never going to have very high profitability ratings. And then it just gets worse. Growth, it rates a 14, but what would you expect? The United States has been electrified for a century now. Where are you going to get growth? You're going to have to get growth from poaching it from another. It's not like there's just a ton of untapped market in the United States waiting to be electrified. It doesn't work that way. This country's been developed for a long time. The fact that the growth rating is even a 14 to me is almost kind of impressive. And then finally, size. Size, it rates at 3. This is a large company. So this is a large lumbering company that's not particularly cheap, has slow growth, low quality. Okay, all that's fine and good, but it pays an income, right? It pays a dividend. Yeah, but the dividend's less than 4% and the growth rate's really not there. So if you're out there looking for income, keep looking. The utility sector is, when people tell you, hey, utilities are good income investments, they're looking at dated information. There are so many better options out there today. There is no reason to tie up precious capital with utilities. So Duke Energy is a hard pass, as is the entire utility sector, as far as I'm concerned. That's going to wrap it up for this week. We'll catch you next week.